Good afternoon, everyone. I am CA Ravi Kumar, and it's a pleasure to welcome you all in today's webinar on Overseas Debt Investment from India, which is organized by the Committee for Member in Practice and Business. To give a brief background of myself, I am CA Ravi Kumar, qualified 2019, and basically doing practice in income tax in cross-border transactions. Today's topic is incredibly relevant today as many businesses are eager to expand internationally with cross-border transactions. ODI. ODI refers to investment made by Indian residents and entities in businesses or assets outside India. This can be through various forms, through equity investments in foreign companies, establishment of branches, subsidiaries, joint ventures, etc. ODI is very relevant today because businesses are growing out of the India for global expansions, for to make the reach better in the world, to access the resources, to diversify the risk and brand building. Overseas direct investment is a powerful strategy for Indian businesses seeking growth and diversification. However, it requires careful planning through research and compliance with regulatory framework. As the global economy continues to evolve, understanding the dynamics of ODI will be crucial for the sustained success in international market. And we, as a chartered accountant, plays a very crucial role in facilitating overseas debt investment. Their expertise is essential the navigating the complexities of cross-border transactions and ensuring compliance with regulatory framework. Here are some of the key roles that CA can undertake in this context. For example, we can do advisory services related to investment structuring. We can help to structure the business in the best possible way in tax efficient manner. We can access the risk assessment to identify potential challenges and develop strategies to mitigate them. CA also plays an important role in regulatory compliance. We have to understand the regulations as framed by the RBI, FEMA, and ensure that clients comply with all the necessary guidelines for ODI. We have to do documentations and reporting. We can assist in preparing and submitting the required documentation to the RBI, including ODI forms, FC, FLA forms, and other reports to ensure timely compliances. We as a CA can do financial planning and analyze. We can do cost benefit analysis to evaluate the feasibility of ODI. We can help business understand the potential return and risk associated with the investment. We can do budget and forecasting. We can create a budget and financial forecast for overseas operations, ensuring that business are prepared for any financial implications. We can do tax planning and tax compliances. Like we have to do tax advisory both in India and the host country, ensuring business optimize their tax liability. Transfer pricing. We can deal with the transfer pricing regulations, ensuring intercompany transactions are conducted at arm length price and the documentation are maintained properly. We can do financial due diligence. CS can conduct due diligence of potential foreign investment. We can also do post investment support like performance monitoring. We can also advise on exit strategies. So these are the important aspects for chartered accountants. How FDI can grow a chartered accountant also. I would like to express my gratitude to the committee for organizing this timely webinar. I will like to I will like to tell you about the committee. The committee for member industry and business are formed to address matter affecting members, particularly in career planning, professional ethics, and enhancing participation in the Institute for Affairs. The committee aims to provide employment services for members and explore avenues for career development. I would like to highlight key activities of the committee involving campus placement program for the new qualified CAs. Committee also introduced women campus career ascent for experienced CAs, overseas campus placement program. It also organized MDP for the rank holders. It also organized MDP for general members. Committees also engage in CFO meets, HR meets, 40 and the 40 award schemes. I, I say committee, basically CMIB committee also give awards to various newly qualified CAs. Further, I would like to thank Dheeraj Khandelwal ji, Chairman of CMIB, for organizing this webinar. His contribution in the area of public finance, startup, and MSME, banking and insurance sector is remarkable. He is also involved in offering advisory services on accounting systems, accounting principles, etc., and they conforming with the Indian and international accounting standards. He's also chaired the work program of various other committee of ICI as a chairman, that is Committee on Public and Government Financial Management, Banking, Financial Service, and Insurance Committee, Committee for Professional Accountant in Business Industry, Career Counseling Groups, and he is also serving as vice chairman for Valuation Standard Board, Committee on Management Accounting, Committee for Cooperatives and NPO sector, Committee for Development of International Trade Service, and WTO, and Board of Studies. He's also authored books on Green Audit CSR, along with his involvement with Lion Club of Mumbai. Now, I am excited to introduce our guest speaker for today, C. Siddharth Kohli. Siddharth Kohli is the founder and CEO of Indigenous, based in Dubai, and brings over 15 years of diversified experience focusing on global structuring, mergers, acquisitions, and tax and transaction advisory. Siddharthi was one of the 20 entrepreneurs selected from the India for the Indo-German Manager Training Program in Germany. With his expertise as chartered accountant, company secretary, corporate lawyer, information system auditor, he is a strategical thinker and problem solver. So prior to setting up Indigenous, Siddharth ji has worked with the Industrial Financial Corporation of India, the Reserve Bank of India, and EY. He currently served as an advisor to the World Bank and also served on the advisory board of the multiple companies across the Americans, MENA, and Southeast Asian regions. Without further ado, I welcome Siddharth ji to start the webinar. Over to you, Siddharth ji. Thank you.
Thanks a lot. Thanks a lot, Ravi. And hello and good afternoon to everybody. It's the run up to the Diwali week, and glad to know that many of us are here trying to understand overseas direct investment guidelines and what it entails. Let me share my screen quickly so that we can get right to the topic. And what I'll do is I'll make it interactive in the sense that I'll be sharing a lot of case studies that have happened in the case of clients. Of course, we'll talk theory, we'll talk what overseas direct investment means, what are the guidelines that have come in almost, I mean, they're not recent, but we still like to call them recent because it's only 2 years, and RBI changes anything only a minimum span of 5 to 10 years. You see the consolidated FDI policy is also 5 years. So it's recent as June of 2022 when the revised guidelines came in, and since then we've been following those. These guidelines are a welcome change because there was a lot of gray area that existed in terms of startups, and I don't know how many of you who are attending right now are tech CFOs or tech company finance controllers, but it is important that ODI guidelines are understood by the MSME and the SME sector, of course, but the startups at large who are right now creating overseas subsidiaries left, right, and center. So what I'll do is I'll quickly share my screen and then we'll get right into the topic. Ravi, if you could let me know if that's visible.
Yes, screen is visible.
Okay, and is it moving too, or do you see it moving?
Yeah.
Okay, perfect. So let's talk about overseas direct investment from India in two sense. One, we'll talk about commercial sense. We'll not only talk theory, as I said, we'll talk commercial sense, and we'll talk actual things happening on the ground and how we as chartered accountants can navigate, because one of the very important player in this whole overseas direct investment scheme of things is the banker who we have to deal with. And in India, banks sometimes can be a real pain to navigate. So I'll deal with case studies that actually happened in the case of clients and how you could go ahead and navigate those with the bankers. Some generic stuff before we move on to the exact why expand globally. Right now, you would see that 1 in 20 startups that we talk to are having plans of going global or have already gone global. Okay, what are the most lucrative markets that you see right now? UAE, USA, Singapore. These have been the markets for the longest years, but you would see that UAE and the US are now on the rise like anything that we have seen before. So the reason being simple: technology companies and even non-technology companies or SMEs and MSMEs, they have started to realize that in the Middle East, the UAE exists at a very, very lucrative kind of a business opportunity, because India, UAE, the whole channel is beautiful, the access to capital is great, the new market can be developed, and from the UAE they can reach out to the MENA region, which is the Middle East North Africa region, so to speak. Saudi Arabia is coming up big time. And on the other hand, there is the US advantage, which has already been there for the longest years, but now it's becoming more and more lucrative, because what's happening is that the whole build in India and sell to the world, if you've heard the terminology, build in India and sell to the world, is gaining huge amount of traction. So that is how a lot of firms that you see listed, unlisted, MSME, startups, everybody wants to go and expand globally. The only catch here remains, and that is why we are on this webinar today, is that the way RBI has structured it and the way regulations around it are structured are slightly complicated, and they're more complicated than any other country in the world. So just to tell you, we operate across 5 countries globally, and nowhere else is an overseas investment as complex to understand as it is in India. But that is because on one side we are a forex deprived country, and the RBI wants very strict control on money moving out of India, dollars moving out of India. So that's the background. A key steps in setting up a business cross-border: you go ahead and you do a market feasibility study. There are firms, by the way, who are now established outside of India only to do market research and connect. So I've had the fortune of advising some of the largest automobile companies in the world, and you won't believe there are players that they have identified who go ahead and actually scout for companies, look for companies in India who can go ahead and set up in, say, Germany, in France, in US, because the Indian technology which is making goods here and manufacturing here is not available outside. And so there are firms now who do this market research and feasibility study for not only you as in the client who wants to go out of India, but there are firms now who are doing matchmaking, where companies outside of India are wanting Indian companies to actually get into their country and set up. So it's the other way around that it's happening, and you need to identify those. So for example, Germany has an agency called Trade, TRAIDE, Trade, and they do matchmaking. They do matchmaking between Indian entrepreneurs who want to move out, and German companies who are wanting to tie up with Indian manufacturers. Because one thing is certain, and all of us would agree, that the Indian mentality and the Indian mindset of and by the way, it is now a word in the Oxford Dictionary, jugaad, that is by far the largest. What a German manufacturer would make, say, for $1 or for €1, the same an Indian entrepreneur could possibly do it at 70 cents to the dollar, or maybe 60 cents to the dollar. So that's how the market research and feasibility study plays an important factor even before you're moving out. And it's not happening only one way, where we are going ahead and employing companies to do a market research outside. There are people who are employing companies outside of India to do this within India. Then there's business structuring. Now, business structuring is perhaps the most important step, which kind of comes even before you've gone into an establishment, because each country has a different setup, each country has a different way of operating, and every economy wants to promote different kinds of companies. Let's talk about, for example, the US. The US has 3 types of companies. There is an LLC that you can incorporate in the US, there is a C Corp that you can incorporate in the US, and then there is an S Corp. Now, which one suits your business perfectly is something that you need to identify before. An LLC in the US is what we typically in India call an LLP. Now, an LLP as a structure will only be suitable for closely held businesses who do not want the complexities that come with a share-based company, which is a C Corp. Now, a C Corp is exactly similar to what we call the private limited company here in India. Now, we need to be mindful of the fact that these kind of entities and the legal structures have to be thought out beforehand. So just to give you an example, the tax and the compliance requirements differ from company to company. In the US, the S corp, which is the entity, which is a type of an entity, is taxed at the same rate as that of the owner, which is a pass through. And there have been numerous cases where people have been advised to set up S corps because it's easier to set up, but ultimately there is huge amount of tax leakage that happens in an S corp setup. In the UAE, the choice of business structuring completely changes. In the UAE, the choice of business structuring comes to whether a free zone or a mainland. A free zone will give you tax arbitrage and tax advantage for some sort of trading businesses, because now in the UAE also there is corporate tax. So if you, many of you would know, from the 1st of January 2024, the UAE has introduced something called a UAE corporate tax, which is at 9%. But if you are in the free zone, you still get an exemption provided you have structured your business properly. The last piece, of course, is local partnerships, which is what you do. You go ahead, I mean, local experts, lawyers, accountants, and consultants, because I mean, a lot of times expertise is not available with us, but then there are tie-ups that we can do outside of India where so ultimately it's, and this is something that we as chartered accountants advise, and I'm sure a lot of you would agree that a good chartered accountant and a good consultant is half the work done. In fact, more than half the work done, because I mean, we as advisors are the ones who actually set up the business. Of course, the entrepreneur is conducting the business, but it is upon us to set up the business in a very clean manner. So that again becomes a very important factor. Regulatory and compliance challenges. So I had a very interesting case. There is a client in India who set up a company. He wanted to actually set up a company, but somebody in the US advised him to set up a branch office and not a wholly owned subsidiary. For the purposes of this webinar, we will call a foreign wholly owned subsidiary a WOS, a WOS. It's called a foreign WOS. So this client of ours, he established, instead of a foreign WOS, he went ahead and established a branch office. Now the branch office was able to get the industry specific licenses that he required because he wanted to. So he was manufacturing brake pads, and brake pads were being supplied to Rolls-Royce and Airbus in the US and Boeing in the US. They are already a company who has a factory in India, but they went ahead and opened a factory in the US under the branch office. Now somebody told them that the branch office is not an incorporated structure and hence does not require an ODI compliance. This is a fallacy. So the test that you have to consider is that any amount of foreign exchange moving out of India, or any amount or any extent of my subscription to a foreign entity outside India, will entail the concept of overseas direct investment and ODI. And an ODI investment ultimately needs a unique identification number, which is called a UIN. And I will just come to the UIN in the subsequent slides. As Ravi mentioned while he was taking up, there is tax and transfer pricing that happens because it is most likely my own entity which I'm investing into. And since it's my own entity, there is going to be transfer pricing that's going to arise. There is a huge litigation for us as chartered accountants, which happens across international tax matters. So if an employee from India is stationed in the subsidiary without being an employee of the subsidiary, it gives rise to a permanent establishment exposure. Now, how we solve for that PE exposure? All of this, us as tech CFOs, company CFOs, finance controllers, finance managers, as consultants, advisors, chartered accountants, all of this is handled by us because we go through the documentation, we go through the contracting between subsidiaries and between the foreign WOS and the holding company. And at the time of the structuring, because what happens is most often we have seen that when you go into a litigation matter, the first thing that the tax officer requires is documentation and is contracting that has happened between the parent and the subsidiary. Now, when the contracting between the parent and subsidiary is done, it is very important to build in clauses on transfer pricing, on permanent establishment, on how employees will be treated, on whose roles with the employee sit, whether it will be on the foreign watch or whether it will be the Indian company itself, those kinds of aspects have to be thought out very well. And the final is HR and visa policies. Now, this is very important because we get a lot of questions from a lot of clients saying, okay, but what happens if I open an entity in the UAE? And this is a classic case. This is a very classic case, and I'm sure many of you would have encountered this classic case with CEOs and entrepreneurs and dealing with that. So the use case is very simple. The entrepreneur says, let's open a company in the UAE, okay, which is it is easy to open these days and fast, swift, cheap. Let's open an entity in the UAE. I require a visa, say to stay in the UAE. I'll work my business from here. And what happens if I open the company and I get a visa and I stay outside of India for 6 months? My residential status changes to a non-resident status because the proviso to Section 6 comes into play, which says that if a person has gone out of India on employment, then the condition for the previous 9 years out of 10 years, 729 days, and all that will not apply, and the non-residential status will kick in. But that is on the India side. What happens on the foreign was side? What happens in the country where you are incorporating? The visa type makes the whole difference. So there have been cases, and you can go online and check. There have been cases which have now gone up to ITAT level to say that the type of visa that you have in the foreign country will determine whether you're actually an employee or you're just so for example, on the UAE, you have an investor visa, you have a partner visa, and then you have an employment visa. So for you to be deciding that, it is very important that you go on an employment visa and not on an investor on a partner visa, because the authorities have started challenging the proviso and the residential and the non-residential status. So these things have to be kept in mind in a practical manner, in a pragmatic manner, for you to be able to implement any financial / tax creativity. Now there are cases, and I don't know, right now there is not a lot that the Indian tax authorities have been able to do. So the very simple case is that I set up a company in the UAE and I'm suppose a tech founder, and I'm actually going ahead and getting an exit from one of my startups. Okay. And the exit is to the tune of say $100 million. And that's true. It's happening these days. Now I'm able to get that money in say a UAE bank account, and because I know, so exit does not happen overnight. When exits are planned, they happen over the course of 3 months, 4 months, 6 months, because due diligence goes on, the term sheet is signed, the definitive agreements are signed, so on and so forth. When that happens, there is always a situation where the founder is tempted, because in India there is no escaping the tax. The founder is tempted to change his residential status to the UAE, go ahead and take the money when he was a non-resident. Now, whether this is completely okay and the tax liability arises or not is a question that I will leave to the audience and the creativity that founders are employing these days. Because till date, I have not seen taxmen issuing notices for these kind of creative tax juggleries which are happening, but they are happening and founders are exercising those. Again, how does that happen? Overseas direct investment. You create an entity outside of India, or you create your own entity, because at the time you create the entity, you are a resident. There is no option, because you cannot become a non-resident overnight. So again, regulatory and compliance challenges kick in there also, and founders look towards us as chartered accountants to give them those advisory pieces, to give them those consultancies, because there is nobody else. Believe me, there is nobody else apart from us who can advise on all these guidelines. Okay. Again, some financial and operational considerations. Most important piece when you go ahead and set up a foreign subsidiary or a foreign WOS is the banking and the foreign exchange dealing that happens. The first thing to choose here is the local bank where you're opening your bank account. And now I will give you a very important practical insight that these days companies, they come up with a bundle package, open a company and we'll get you a bank account along with that. The bank account that some of the service providers often offer you is a bundled bank account in an online bank. Say a Vio Bank in the US, say a TransferWise Bank in the UAE, a Vio Bank in the UAE, TransferWise in the US, so on and so forth. Now, the beautiful thing about this is that it works exactly like a bank without being a bank. So you can't go and physically deposit money or take out money or do checks and all that, but it works like a bank account. You have the IBAN in case of UAE, you have the SWIFT code and the bank account number in case of the US. But what can you actually do with that bank when it comes to your bank here in India? Can you actually send share capital into the TransferWise account or into the VO bank account, which are online bank accounts? The answer is no. The AD bank, which is the authorized dealer bank here in India, will say no to an online virtual currency bank account. So it is very important for you when you're setting up to choose your bank account properly so that the whole overseas direct investment guidelines are not flouted. And what happens is bank accounts opening in foreign jurisdictions are a real pain, and you would realize that given the we used to talk about ease of doing business in India, and believe you me, I have seen this since the shift has happened to Dubai. I've seen the ease of doing businesses in India is is out of this world. Banking in different jurisdictions is a huge pain here in today's day and age. What do we say when in India we're talking? हम एक सिंपल एक चीज बोलते हैं यार यहाँ पे तो बैंकर घर आ जाता है, right? And you realize when you go to the UAE or to the US or to the Singapore that banking is a real pain. So when you are and you realize suddenly, because you open your entity, you open the bank account in say a VO bank or a TransferWise or say Revolut. These are the famous online virtual currency and virtual bank account providers. Then you suddenly realize that you are stuck with a situation where now you have to undo this entire process. And opening a real bank account takes about 2 months in a geography like a UAE. Yeah, it takes about 2.5 months also in some cases. So as I said, we complain sometimes that India takes time to do things. We got a rude shock when we started doing this shift there. So it is very important to choose a bank account like a real bank account. You've got HSBC doing global operations, and the other thing is choose, if possible, a global bank where you're banking with them in India also. For example, HSBC does banking globally. ICICI Bank has operations across Singapore, US, and India. Try and choose ICICI if possible. Bank of Baroda is another bank which has operations in India also, and of course it has operations in the UAE also. So try and choose things where your friction can be minimized. The most important piece is that in India, the AD bank, which is the authorized dealer bank, has to be aligned with your thought processes and with the trade finance and the trade desk. So these people who are actually dealing this in India are the trade desk people, and the trade desk people are the ones who actually uh, you know know what an ODI requirement is, how banking works, because in some cases we have seen clients struggle for even 4 months and they do not get a UIN. Why a UIN is important and what it is will come into the next slide. But you have to be very, very careful in aligning your own bank, which is the AD bank. Choose the bank in the foreign country properly, and make sure that it is a real functional bank and not an online virtual currency account. Okay, and of course the currency fluctuation, again we have a role to play where we decide what is the rate, we choose the currency rate and all of that. And finally, of course, cost management. We as professionals, we have to be mindful of the fact that some geographies can be very, very expensive to operate. Like for example, the UAE, very expensive. US considerably less expensive, easy to set up, and does not require a local director, does not require a local office presence and all that. You can operate virtually, and up to say 50 crore, the place of active management guidelines don't kick in, so substance you can avoid. All of those things you need to be mindful. So it's not just overseas direct investment from a RBI and a FEMA angle. There's tax angle to it, there's operational angle to it, there's banking to it, and of course there's a side which is the cost which you have to take care of. Ravi, do we want to pause for questions in between, or should we just straight away move on to and we'll take questions in the last? Ravi, do we want to pause now for questions, or should we take questions at the last only?
So we can take the question at the last.
At the last, okay.
Yeah.
Okay. Okay, I'll move on to the next slide. Now, what are the key overseas direct investment guidelines? What is an ODI? How do you do an ODI? what are the real steps in doing the ODI? The previous slides were a general overview and practical insights into what happens in actually doing an ODI. But what actually is the ODI and how does it actually come to being? So first steps first, Indian entities can invest up to 400% of net worth. This Indian entity word is important because this entity, i.e., came into place, it was replaced by the terminology IP, which existed before June of 2022. Before June of 2022, it was called IP. After, it's called an Indian entity. What is the difference between an IE and an IP? Before, the IP used to have a one single UIN. For example, if me and Ravi both wanted to invest, say, in a company outside of India, we both were collectively termed as an IP, and both our net worths could have been combined. Now, an Indian entity who's investing on a separate basis is termed as an Indian entity, and their net worth of up to 400% has to be looked at. Right? A company that has, say, a 10 crore worth of net worth can invest up to 40 crores in the overseas subsidiary. Second most important thing, as I said, is operational bank account for making investment is very important. It cannot be an online bank account. The third piece is you go ahead and approach your AD bank for making the investment. The fourth is you obtain a UIN from the bank. And fifth, of course, you file for compliance. Now, what is the third piece? What is it, and how do you approach the AD bank for making investment? And when do you need that? Let's look at one or two slides later, and then we'll come back to this. Okay. What is an ODI and an OPI? What is the meaning of ODI? The meaning of ODI is very simple. I just increase this size a little bit. So overseas investment can be defined into two. One is ODI, which is an overseas direct investment, and the other is an OPI, which is an overseas portfolio investment. Now, what is an overseas direct investment? An overseas direct investment is when I'm making a financial commitment to a foreign VOS or a foreign entity. If you see here, it talks about ODI, equity capital of unlisted foreign entity, subscription to MOA of foreign entity, 10% or more paid up capital of listed foreign equity, or acquiring control in foreign equity irrespective of the paid up capital percentage. Now, this is important in light of the fact that I can even assume and exercise control over the company without having a paid up capital, which is governed by way of an SHA, where I have affirmative right of action, where there is no 10% available to me, even if it is a listed entity. And there have been cases in the past which have been deemed to be an ODI by RBI and said, go ahead and take permission from RBI for ODI and not OPI. Otherwise, OPI also available, and I'll tell you what OPI is, but let's focus on ODI for now. Now, there is a term here, equity capital of unlisted foreign entity is very clear. When you go ahead and you open a foreign VOS, you go ahead and you open a subsidiary of yours. This is called a equity capital subscription. The next is subscription to MOA of foreign entity. Now, this is where the real pain has actually started. Up till now, what used to happen, we used to subscribe to the foreign entity, and at the time of sending the money, we used to go ahead and approach the RBI and ask them for giving us the UIN, which is the unique identification number. UIN is the unique identification number which the RBI gives upon making an application. The application to RBI for investment into a foreign entity is made in a form called Form FC, right? Form FC ODI, and within that form you fill up details of the foreign entity, where is it based, what is the percentage you are acquiring, what is your net worth, and so on and so forth. Now, the subscription to MOA itself is the event which triggers the ODI happening in India, which means that if you have made a company in the UAE or in the US or in Singapore or wherever in any part of the world, in London, Europe, you go ahead and tell your AD bank that here is a company that I am subscribing to, I am taking shares of, and I want to do a UIN. If you are not doing this, if you are not doing the subscription to MOA of the foreign, if you are not informing the AD bank of the subscription to MOA, then you end up in a situation which is this, which is a deferred payment situation. See that on the right? It's called a deferred payment situation, where if you are going ahead and making a subsidiary and not subscribing to the not issuing capital, share capital and sending money out, but you just want to go ahead, open the entity and start business. Sometimes what happens is, sometimes you want to send say 10 crore rupees into a foreign boss, but you don't want to do it right now. Right now you just want to send say 1 lakh rupees or 5 lakh rupees or 10 lakh rupees. You can go into what is called a deferred payment agreement between your boss and your entity in India, and submit that to your AD bank to say that we will subscribe to the balance capital later on. The AD bank will take that on record. The unpaid part, which you have not paid, will be treated as non-fund based financial commitment. It still stays financial commitment, but it is called non-fund based. The fund based is the one that you have already sent money out, and this will be considered as the overall limit for the 400% net worth criteria under the deferred payment circumstance. So simple steps, what you do when you're going ahead and deciding to form a company outside, go ahead, approach your AD bank and tell them that you will be subscribing to shares of the foreign entity, and the moment you become a subscriber to memorandum, submit the form to your AD bank and get them to issue the UIN. Because if there is delay here, people are still living under the impression that we have formed the entity but we have not sent the money out. It does not matter. When we send the money out, that is when the criteria of ODI will kick in. But that's not true. There have been cases where you have to do compounding, you have to pay late submission fee, LSF fee, if the subscription to MOA is not done on time and the reporting is not done on time. Of course, the others are pretty straightforward, same 10 or more % paid up of listed foreign entity and acquiring control, as I've just talked about. A very important factor is a non-fund based facility. Now, what is a non-fund based commitment? A non-fund based commitment is, for example, a corporate guarantee. A corporate guarantee on behalf of the foreign boss is also an enhancement of the ODI limit. So, for example, you have say invested a sum of say $1 million in your foreign boss, and now over and above that you are issuing corporate guarantee in favor of a debt provider who's providing debt in the foreign entity. Now the moment that is happening, you are entering into something called a non-fund based facility, and this is also applicable to the overseas SDS of IE. Now what is an SDS? SDS is a step down subsidiary. So if you have a VOS and the VOS has a subsidiary further down, that is called a step down subsidiary. Even for a step down subsidiary, if you're issuing a non-fund based facility, that has to be reported to the RBI, because sometimes what happens, these are actually reported cases that we have just represented before the RBI, where an individual client, like a corporate entity, but the sole founder, he went ahead and opened a subsidiary of his company in US, and then in the US opened a further subsidiary in the UK. So the UK company was 100% held by the US company. The RBI came back and said that you did not report to us the opening of the subsidiary of the US entity, whereas as founders, and as CEOs, entrepreneurs, they were of the impression that only a first level down subsidiary is what we have to report to the RBI, but that's not true. If your foreign VOS is happening, a subsidiary is actually entering into a relationship with another entity which is called a step down subsidiary in India, they have to report it back to the RBI and obtain a UIN in that respect also. Debt instrument supported by loan agreement and interest and arm's length. Debt other than OPI, meaning debt other than overseas portfolio investment, and any amount of debt given by the foreign by the Indian company to the foreign VOS is also part of the financial commitment and is also part of the whole 400% criteria that exists. So the debt that I as an Indian entity is giving to my foreign VOS is considered as a financial investment and has to be reported as ODI. Now, what is an OPI? This is an ODI. What is an OPI? You must have heard over the course of last, and I'm sure many of you would already be doing that also. There are companies now who are providing facilities for us as individuals to invest in foreign stocks. Okay. Now, and I'm sure many of you right now are proud owners of, say, the Tesla stock, or say the Apple stock, or the Amazon stock. Now, when we say that we own stock or we own shares of these entities, how do we do that? We don't have to do this entire process on the left. We don't have to go through the whole overseas direct investment guidelines, because we are not making a direct investment into the company. We don't want to exercise control. We are not subscribing to 10%. I'm sure if any of us has subscribed to 10% or more of a listed entity in the US, then then I need to come take a lesson and understand as to when that investment had happened. But that situation not being present, there are definitely ways where we continue to own. There are now schemes which actually operate an SIP, a systematic investment plan, of investing into US stocks only. And I don't know if many of you have heard or not, but it's called the FANG. FANG has of course not become Mang, but earlier it used to be called FANG, which was Facebook, Amazon, Apple, Nvidia, and then another country. So these another company. So when you own these FANG stocks, now it's called Meta, Apple, Amazon, Tesla, and one other. But these were the main deep tech or the tech companies operating out of the US, and you used to proudly say that I'm owning a FANG stock or a Mang stock. All of that happens through the overseas portfolio investment guidelines that have been issued in respect of overseas direct investment guidelines issued by the RBI. Now, there is also an investment in the IFSC which is covered by overseas direct investment guidelines. I'll come to that in a subsequent slide. That is also a very interesting area of practice which is coming up, which is the IFSC. Okay, so we approached the AD bank for making the investment. We obtained the UIN from the bank, and we finally went ahead and made the ODI. Of course, after the ODI is done, we have to file for compliance. We'll come to compliance later in another slide as to what compliance is required, because there is a very important practical insight on compliance also that I want all of us to remember and know. But once the UIN is obtained, that's when your entire ODI process is completed. The other beautiful fact is that we as chartered accountants do a lot of due diligence. A lot of you would be doing internal audits, due diligence. When you and of course statutory audit being an integral part of what we do. When we go ahead and make that the assignment of due diligence or internal audit, we figure out that a lot of times people had made investments, but they don't have a UIN. And these are, in my case, and I'm sure you would have also, in my case, I have encountered companies as big as listed entities who have gone ahead, made investments in overseas subsidiaries, but have not complied with any of the RBI guidelines around overseas direct investment. So the process gets completed only when the unique identification number is issued by the RBI. Okay, and I'll come to compliance as to what compliance is. Now there is a fun fact, and the fun fact is that property in Dubai, which everybody of us is buying and a lot of our clients are buying, is not allowed as part of the overseas direct investment guidelines. It's only allowed up to a limit of $250,000, which is prescribed under the LRS guidelines. So anybody and everybody who's going ahead outside, there are ways to do it, structure it. This is not it. The people are going. I have encountered folks who are going to the UAE. They had some cash lying in the UAE. They had some money lying in the UAE. They give that money to the builder, and they send about $1,000 from here or $100,000 from here in India under the LRS guidelines. So they stay below the limit of the LRS guidelines, and they believe that they have complied with everything. That is not the case, and that is not true. So the property that people are buying in Dubai, please advise your clients, do not do that. I use a terminology that these stunts are performed under supervision. Please do not try them at home. So use that terminology with people who are buying properties left, right, and center in Dubai. Okay, I'll come to compliance. I'll jump to compliance, and then we'll go back to how the major change in a step down subsidiary mechanism has happened. But compliance. What do you have to file as compliance? Compliance is two-step compliance. Filing of FLA. FLA is a foreign liabilities and assets return. It's called the FLA return. It is filed by July 15th of every year. One very important factor that you need to choose is that what do you want as your financial year? Because in the US, the default financial year is Jan to December. And when you're incorporating the company, sometimes you forget that you have to tell the registrar to actually choose April to March, because you have to align that year with the Indian year. The default year is Jan to December, and then once that has already happened, you realize that you have to file for Jan to December, and then later on the work begins. So be very careful in choosing April to March. Now, when you've actually chosen April to March, by July 15th of each year, you have to file for an FLA return, and an FLA can be done on the basis of unaudited provisional results of the foreign WAS. A foreign liabilities and assets return basically tells you what asset investment that you've actually made money from an income from a overseas direct investment perspective, and then if there is any debt on the top of it that you have already sent. Okay. So these are some of the criteria for the FLA return. Then you have something called the APR. APR is actually the annual performance report, which needs to be filed by December 31st each year. An interesting piece here is that, as I said, if the period is Jan to December, then the FLA filing gets due on the next December 31st, which is the year after. Now, the most interesting piece here, and that's where I said that we are dealing with practical difficulties in the filing of APR this last few months, and we had this last year also. Those of you who would be filing your APRs with the AD bank, and especially some of the banks, are insisting on an audited accounts of the foreign WAS. Now, audited account of foreign WAS is actually a requirement which has been displayed in the new ODI guidelines, and the point is well taken. However, who needs to audit the foreign companies' books of account is not mentioned. And I'll give you an example. In the US, in the UAE, in the UK, and in Singapore, all these four places, the audit is required only when you hit substantial milestones. And say, for example, in Singapore, you are required to get your books audited only if you are a company that has a total assets of more than $10 million and a total turnover of more than $50 million. Right? And then there is a criteria of more than 50 employees. So out of these three, if any two are complied, only, and the two is like and, it's not or. So out of these three, you need to have two hits. Only if you have two hits, then you need to get your books of accounts audited in Singapore. Now, there is no requirement for me to get my books of account audited in Singapore. But there are some banks who insist that we need books of accounts audited by a Singapore local CPA or a Singapore local chartered accountant. Now, whether the guidelines have prescribed anything of this sort, the answer is a strict and a complete no. Now, for the entrepreneur, for the investor, for the CEO, and for us as tech CFOs and members in the industry, it is very important for us to realize that audit fees outside of India is a bomb. So anybody doing a mere minimum books of audit account auditing in Singapore will ask you for $6,000 to $8,000 to $10,000. Now, the requirement of getting this audited in Singapore does not exist as on paper. So the thing that we need to, and some banks, by the way, have taken this internal I would say decision in as part of their board meeting or as part of their extended risk compliance, where they are passing this onerous obligation on the founders and on companies, on industry members. This has to be avoided at all costs. And here comes the opportunity for us also as consultants and as advisors and folks who are in the industry to actually make the banks aware that these set of books of account can be audited by an Indian chartered accountant also. Now, whether an Indian chartered accountant can audit those books of account from a legal perspective, they are not required to audit. This is called an audit of a special purpose vehicle. There is a special standard on auditing which prescribes that these set of books of account can be audited. I would say that a test function can be performed. I would not really say audited, but a test function can be performed by an Indian chartered accountant, by an Indian practicing chartered accountant on this. So make sure that you don't get into the hassle of getting your books of account audited by a foreign chartered accountant, because that will delay the process and that will mean a cost that you incur. So this was an important practical insight that I had. The last point, and why I have that mentioned in italics, is issuance and delivery of share certificates. Now, I told you in 2 slides back that the ODI is complete when the UIN is received. There is actually a further step which is after the issuance of UIN, and that is issuance and delivery of share certificates. Because that's when the RBI in their guidelines recognize the ODI to be complete, where you say you have received delivery of share certificate. We have seen in the past, we have seen issues where the share certificates have been missing, and there has to be compounding which has to be done because share certificates are not there. And lot of geographies, for example, don't issue share certificates, and as is the case in India. For example, US does not issue share certificates. You have to make those in your in house in your teams, and then print them and send them. They only give you a draft. Now, if I have failed to kind of have that semblance or remember to issue and deliver share certificates, please make sure that you go ahead and print them and put them in a physical file, because you can always do that even now at present. So this is a yearly compliance that you have to follow. Of course, there is other compliance which is in terms of transfer pricing, but I'm not going into that. I'm restricting myself to the RBI compliance that needs to be done. But there is also a transfer pricing compliance that needs to be done. There's an income tax compliance. We need to disclose the investment in an overseas subsidiary, so on and so forth. Okay. Now, okay. I don't know how many of you have actually heard the whole round tripping issue. There is a massive debate that goes on in India on the whole round tripping issue, and I don't know if some of you have heard the term flipping, where you say that we have flipped the structure. You flip the structure, you take the entity outside, the hold co changes, the founder is Indian, he stays here. So that's a flipping structure. And I mean, I am myself guilty, and there are a lot of firms who are guilty of suggesting that structure to founders. But it was at that time, it was a perfectly legal structure. It involved, as I said, it involved creativity, regulatory creativity from setting up that flip structure, creating the hold co outside. But I'm sure many of you would have seen now that we must have read the news called PhonePe pays almost $1 billion in taxes and flips back into India because they want to do an India IPO. Very recently, you're seeing Razorpay trying to do that. Now we are seeing CleverTap, which is again a $700-800 million company who wants to reverse flip. Why the reverse flip? The reverse flip is happening very simply because the Indian market and the stock markets are giving multiples which no other economy in the world is giving right now. China, we don't know, of course, because the news does not come out. But India is giving the maximum amount of returns on the stock market, and people are really, really, really bullish. And that is why a structure called a reverse flipping has started, where you took the holdco outside, and now all investors are okay. Suddenly, all investors are okay investing money into India. Suddenly, any red tapeism or any bureaucracy around investment has gone. So people are very okay investing into India. They're very okay to put their money into India, so on and so forth. The best part about this is that the RBI realized, and that is why also one of the main reasons why we feel that a notification like this came into play was because RBI realized that there are a lot of companies who are flipping outside India. I mean, I can count fingertips, and you would know a lot of companies where the holdco is outside India, the founder is here, the main work is happening here, the IP is getting built here. But because of that small loophole or the lacuna that existed in the law, the whole round tripping structure was being implemented. And what that actually means is, you as an Indian entity, you open a foreign VOS. Okay, you own the foreign VOS as an Indian founder, as an Indian entrepreneur. You own the foreign VOS, say 100% or 80%, and the 20% is the investor. And now this foreign VOS goes ahead and establishes a company in India. Now, in RBI's terminology, what have you done? You have actually done round tripping, because you have gone ahead, you have made an entity outside India, and this was has then actually created an entity here back in India. Now, this is banned, and actually, in some ways, was banned as well. But there used to be a very creative gifting structure which we used to follow, where what we used to do, and I'll be very short in explaining this because otherwise it will confuse you, those of you who don't know this. We used to set up a company outside India. Foreigners non-residents used to set up this company outside India. And these gentlemen who used to subscribe to the shares of the foreign entity used to then gift those shares to the Indian founder or to the Indian entrepreneur. This way, the Indian entrepreneur has not gone ahead and established a company outside India. So the question of round tripping is avoided. And that is how we were able to, come into that regulatorily creative zone where a foreign company's shares were gifted to an Indian founder and he became the owner of those shares. And then this foreign company made an Indian subsidiary. Now, RBI did two things. RBI, first of all, banned a gift of shares from anybody but a relative outside India. So, as long as you are a relative, you can go ahead and take a gift of shares. If you are not a relative, as defined within the meaning of the FEMA, which is the Foreign Exchange Management Act 99, if you are a relative under the Act, you are allowed to take a gift, and relatives definitions under FEMA and under income tax are more or less similar. So if I am a relative, I can take a gift of shares from outside India. If there is an unrelated entity, like I said in the case of these two gentlemen or three gentlemen who used to subscribe to shares and then gift the shares, they are not my relatives, they are consultants or they are advisors who are present in Singapore, or my friend, say for example, who is in Singapore or in the US or in any other foreign country. That is not allowed because they're banned. However, they have eased out a two-layer step-down subsidiary mechanism. And what is that? And that is why I've written, and I will read this verbatim because I've written this. This actually is a breakthrough amendment that permits the overseas investment followed by the foreign direct investment back into India with a restriction on the number of layers of subsidiaries. The new framework clearly specified that investment in any foreign entity is restricted if such investment results in a structure having more than two layers of subsidiaries of the foreign entity, which essentially means that the foreign entity is only allowed to have two layers of subsidiaries, meaning you have an entity here in India, you go ahead and you make a foreign VOS. Now the foreign VOS can have only one in, say, in that country or any other country, and then one again back in India. More than that, that is banned. But the structure of the overseas investment is completely different, and how we will understand it through a case study. Let me go through a case study. I've prepared a case study specifically to understand how a foreign VOS can be structured. Okay, I'm sharing the screen again. Let me know when it's visible. Okay, Ravi, is my screen visible?
Yes, it's still invisible.
Okay, so let's look at this. So a foreign company, a foreign company has two shareholders. One is an Indian resident and the other is a non-resident. Okay, let's take for example, the client is a US-based company. The promoters of the company are evaluating the option of setting up a subsidiary in India to cater to the ever-growing Indian market. Let's assume the current structure has a US company FCO with two shareholders, one Indian and another non-resident, which is for a non-resident we are not concerned because he's a non-resident, but there is an Indian resident also. Okay, what happens? Let's stay on this structure. What happens if the Indian resident here subscribes to the foreign company and the foreign company that opens a subsidiary back in India, the whole structure is round tripping because the Indian resident has subscribed to a foreign company and the foreign company has thus invested back into India. Before we used to have this Indian resident get the shares of the foreign company through gift. Now this gift is banned, so you can't do the gift. What do? You go ahead and you create something called a ICO. Okay, so an ICO is actually an Indian company one, which is now allowed by the RBI because the RBI has said that an individual making an investment into a foreign company and then that foreign company investing back into India is not something that is allowed, and that is round tripping. However, if these individuals in India form a company or an LLP, which is a body corporate structure because the guidelines say corporate, body corporate, LLP and Indian company are both body corporates. I need to, as the individual shareholders, form something called an ICO, an Indian corporate company. This Indian private limited company will then invest in the VOS, which is the foreign company. And then foreign company can invest in the ICO 2, which is a subsidiary of the foreign company. So in this scenario, you will create three structures. The first structure will be the Indian residents coming together to create the ICO 1. The ICO 1 then goes ahead and invests in the FCO, which is the foreign company. And you can invest to the tune of whatever your structure is 60, 70, 80, 50, 90, whatever your structure is. The 10% is assuming held by the foreign company, another non resident in the foreign company. This foreign company can then own the Indian company 2, which is a new structure, a separate entity which is different from the ICO 1. Now, why this structure? Because sometimes investors are still, a little jittery about investing directly into India. So what they say is, you go ahead and form a foreign company. We will invest in the foreign company. That's all they say. They don't care about all this structuring. They don't care about the ICO 1, the ICO 2, and the round tripping and RBI and all that. Their main concern is that we want to invest in a structure which is outside India, because taking money from outside of India is easy. Anyway, that all those concerns have anyway been addressed by a lot of regulatory changes that have happened on the Indian side. But still, there are some investors that insist on this. Now, to do this and why this structuring? Why do you need to have an ICO 2? Because the investor wants the ICO 2 to be connected to ICO 1, because ICO 2, which is the India company, is where the entire magic is happening, where the technology is housed, where the people are hired, where the whole tech is made. So that company needs to be under the control of the foreign boss, where the IP is sitting, because the IP sits in the foreign company. And that is why this kind of a structure is advised to clients. What happens operationally? Operationally, the customer's client in India contract with the ICO 2, and the revenue with such contracts is accounted as the revenue of ICO 2, because Indian contracts and Indian clients of the ICO 2 will be handled by the Indian company, which is a subsidiary of the foreign company. However, there will also be a scenario where this particular foreign company, which is the holding company, will have clients over the world. So any player or any client who wants to pay outside of India pays in the foreign company, which is the FCO. The ICO 2 bills the foreign company on cost plus markup basis. Because what is the ICO 2 doing? ICO 2 is servicing the clients in India, because these are Indian clients. On the same lines, the ICO 2 is also billing the foreign company on a cost plus markup basis, because the revenue from India may not be as much to take care of the technology cost, to take care of the people cost, to take care of the ops, to take care of the admin. Now, for all of this, you bundle it together and you do a cost plus markup. And cost plus markup, you can check with transfer pricing professionals. There's a safe harbor rule. You go into 8, 10, 12, 15, depending on what the safe harbor is in terms of the sector that these guys are operating. You go ahead and you formulate this structure. Now, this is an advisory which goes and applies directly in your case if you want to have a foreign company which is outside of India. The foreigners or foreign investors don't want to invest in India. This is a structure which goes and fits directly into a use case scenario. The ops, as I said, IP and tech to be housed in the foreign company, founders to become employees of the foreign company. So whoever are the employees, they get into employment agreement with the foreign company. They remain directors of the Indian company, which is completely okay, because an Indian founder anyway has to pay tax on whatever he's earning globally. So it's completely fine. They also become employees of the foreign company. They continue to be employees of the India company, which is the ICO 2 in our example. And the IP and the tech is housed in the foreign company. So tomorrow when the sale happens, the entity at the foreign level, which is the FCO, gets sold out. The ICO 1 and the ICO 2 continue to exist. The Indian founders get an exit through the ICO 1, because the ICO 1, which is a shareholder, gets the money. There is a bit of a tax leakage because the ICO 1 will have money sitting in when the ultimate exit is happening. And the ICO 1, when the money is taken out of ICO 1, if it's a private limited entity, will have to again pay tax on dividends. So to do that, operational thinking of whether you want it as a company, which is the ICO 1, or ICO 1 in our example can also be an LLP, because you don't get taxed twice once the exit is happening. So sorry, this is a longish kind of an advisory. I hope this is clear. If there are any questions around this, we can take at the last. But this forms a very important advisory in today's time, especially when the flipping had happened or the reverse flipping is happening. You still require foreign companies to operate. We have had listed companies as our clients who have faltered on this in 2021 22, when the whole tech boom was happening and people were outside India and they wanted to quickly create an entity. Flipping happened, gifting happened. All of that has to be now unwinded. It's called the unwinding structure. Before the RBI, you need to change the structure. You need to properly, because the RBI, while it was perfectly legal, let me tell you, why it was perfectly legal, but FEMA as a law, and you have to understand, as professionals, income tax operates on the literal and the legal interpretation of the law, whereas FEMA is a law which is based on more substance. So if we are violating substance, which the RBI has now come back and told us that we are violating substance, and we actually violated substance when we were flipping companies outside India, we have to unwind the structure and go into a regulated structure, which is this. And I will again quickly just go to the proposed structure on how we close this. If there is a requirement to create a foreign company, two individual investors or one individual, even if it is one individual investor, they go ahead and form maybe an OPC. The OPC goes ahead and invests in the FCO, which is the foreign company. The foreign company then creates a subsidiary in India, which is the ICO 2, which is the main operating company. The ICO 1, which may be an LLP, which may be an OPC, which may be a normal private limited entity in India, is only formed for the purposes of housing the shares of the FCO. That is how the whole structure is played out. If there are any questions on this, I'll be happy to take. Yeah, I think I'll go back to the slide. I'll go back to the main slide. Okay, sorry, I was just reading the question. Okay. Yeah. Okay, so this was on the 2 layers of step down subsidiary. I just read a question, and I'll come to that once I finish this. It's an interesting question. Okay, I'll come to case studies now, and then maybe we can maybe go back to questions. But these are actual case studies as to what's happening, and these are all actual practical discussions and decisions that have happened in the case of companies. Case study 1: company ABC Private Limited opens a WAS, creates $100 share capital. Okay, $100 share capital, and the company is a XYZ LLC in the US. Right, the US company opened on March 1st, 2022. Founders deposited $100 in cash in one neobank account. Okay, they went ahead, they opened, they took out cash, and they kind of deposited cash in the neobank account. Cash in the neobank account is not possible. Say, assuming in the US itself, they withdrew $100, gave it to somebody, and said, please put this money into our account and transfer it to our entity because we want to subscribe to share capital. Now, what is the problem? The overseas direct investment guidelines get triggered because the guidelines state that in India you need to have a proper bank account which is of the entity outside of India. The bank account needs to have a proper ODI reporting, and there also needs to be tax reporting. So this form, and these are countless cases, by the way. You see, what is the way out of this? Now we know all of this, that this is not correct. The way out of this is you need to suo motu approach your AD bank. You need to form and submit something that is called a regularization memo. A regularization memo includes listing down the entire facts and stating that we have actually entered into this particular transaction, and this particular transaction needs to be voided. The whole regularization with a particular AD banks can even take up to 3 to 5 months. So if there is a possibility of a situation like this arising, act now. So at least till March 25, you are able to sort your books of account. That is which exists, and this is case study 1. let's go to case study 2. Okay. Company ABC, Private Limited, 10% holding, XYZ LLC, RBI reporting done, ODI compliance done, bank account compliance done, everything done. However, post the investment being made, once we have made the investment, the net worth of the India company becomes negative. Okay, the net worth of the India company post making the investment becomes negative. What happens to a scenario where post the investment being made, the company's net worth become, because I mean you can only invest up to 400% of your net worth. So anything which is negative, a 400% of negative will always remain negative. So what do you do when this kind of a situation arises? There is another example here, which is what happens in the case of individuals who want to do a simple ODI, not a, so this is a corporate ODI happening. What happens if I as an individual want to invest in a company outside India and open a single sole owner foreign entity? Will the LRS guidelines apply on the net worth, or will the capital account transaction be so there are two kinds of investments. The way I can make investments is, one is in the form of LRS ODI. LRS ODI is a liberalized remittance scheme where I can invest up to US dollars 250,000 as part of investment into a company outside of India. Then there is something which goes beyond this. This is called a capital account transaction, where I need to go ahead and take an approval from the RBI. Now, will a 400% limit of the net worth apply on individual also? The answer is yes. So an individual also needs to have his or her own net worth determined by an Indian chartered accountant before we go ahead and apply for EY. Now, what happens in a case where post my reporting, the net worth of the company or the investment that I did came down? In such a scenario, the investment that I made and the UIN that I received from the bank remains valid. However, any new investment into the WAS is completely banned and is completely stopped. So you cannot, until the net worth becomes positive and it reaches a limit so as to satisfy the investment that was made in the previous round. So for example, you made an investment of say $500,000 round, you need to have a net worth of 125,000 equivalent Indian rupees for you to satisfy the $500,000 investment. Now, if you want to make another $500,000, you need to have a further investment and a further net worth, positive net worth of 125,000 US dollars. Okay. Right. Case study 3. This is a very interesting case which has actually happened in the case of our clients. A and B are two individuals. Now, A and B, two individuals, go ahead and open a bank account in the US. They are US residents. They open a company called XYZ Inc. USA. Okay. So they are, A and B are two non-residents. They stay in the US. They have a US bank account. They earn US income, and they go ahead and make a US investment. Okay. And they open a company called XYZ Incorporated, which is say a C Corp. As on the date of making the investment, the transaction is completely valid. You don't need to come to the RBI. You don't need to approach your AD bank. No need to do anything on those sorts. However, subsequently, A and B became Indian residents. Okay, they came to India. They left their jobs or whatever they were. They came to India and they became Indian residents. Now, once they became Indian residents, they went ahead and used the US bank accounts that they had to invest money into XYZ Inc. USA. That's a completely valid transaction and a completely okay transaction to do as far as a commercial transaction is concerned, because I have money in the US bank account. I opened an entity XYZ Inc. in the US, which was a C Corp. I went ahead and parked money into the account. What happens? The simple rule and the clear-cut guideline that you have to follow is that once you become an Indian resident, and as is the case with tax, and you know, in our parlance we call it कि जब आप हिंदुस्तान का बच्चा बन जाते हो तो आप पूरी विश्व की इनकम के ऊपर यहाँ पे टैक्स देते हो. Exactly similar happens in the case of FEMA and RBI as well. The moment you become an Indian resident, you go ahead and comply with all FEMA guidelines that are applicable to you. So even if there is a first and the foremost is that as an Indian resident, you can't, and this is the most important revelation that I'm going to make right now, as an Indian resident, you can't have a foreign currency bank account in another country. So all of you who have, please make sure that you advise your clients or us ourselves that as individuals we can't go ahead and have a bank account outside of India and can't be operating a bank account outside of India, which is a savings bank account, which is in a different country, as being Indian residents. There are different ways to do it, but let's not go into that. But if I'm using that particular bank account to make this investment, it is wrong. I have to use an Indian bank account, approach my Indian bank, even if I'm an individual, say an ICICI bank or a Kotak bank or an HSBC, wherever my bank account lies. I approach my relationship manager and I tell them I need to make this overseas direct investment in an in a foreign WAS. And then that's where they guide you through the entire process. The form FC and ODI are filled up. Based on your net worth, you are able to send money out into the foreign WAS, take a UIN, and avoid FDI ODI violation. If there is a case where this has happened, and there are situations, and because people do it all the time, they come back into India, they have the US entity, they keep on investing into the US entity from the US bank account. Please make sure that the investment is legalized and regularized, because otherwise it continues to remain a non-compliant transaction. Okay. All right. I think these were the few case studies that I had on my end. I tried to cover the ODI guidelines. I tried to cover practical insights. I tried to cover a very important round tripping issue. There's an LRS issue also that exists, but LRS I think we can take up separately, or maybe if there are questions we can take those up. But these were some of the most important burning topics that we have encountered as far as the overseas direct investment guideline and the practice is concerned over the last 2 years, because that's the most burning issue. Net worth has also been aligned to mean earlier securities premium was not counted in the net worth. You only had share capital and reserves and surplus. Now share premium is also counted, which is in line with what Section 2 of the Companies Act prescribes. So those guidelines have also now been aligned with net worth. There's a lot more, and the guidelines are very, very so you're governed by guidelines, you're governed by rules. There's a master direction on overseas investment. So there are a lot of guidelines that exist. I've tried to cover practically whatever is applicable and whatever comes into being on a daily basis. There are exceptions always there, where a branch is opened, unwinding needs to happen, the write-off of the subsidiary happens. I've not dealt with the write-off here, but there are cases, and I'll just quickly spend 2 minutes on a write-off transaction where you have made investment in a foreign company or a foreign WAS, and it did not do well. There are cases where it does not do well, right? You can't do anything about it. If it does not do well, then there are situations where the write-off or the disinvestment, it's called the divestment in ODI terminology is called divestment, where the divestment of the investment happens. So you either transfer it to another entity, which again requires an approval here in India. You file with the ODI, with the AD bank for a divestment of the overseas investment, or a write-off of investment. A write-off of investment cannot happen for unpaid money. A write-off of investment can happen for the paid money into the foreign WAS. And if the subsidiary is not doing well, you need to again approach the AD bank. Reason for the subsidiary not doing well, what all went through, and all of that. That is called a write-off. So I think with that I'll just finish this. Available for questions. You want to take questions? You have any further discussion happening? Anybody asking questions? I'll leave it to you.
Yeah, sir. Actually, we have received one question. If I have from Anuj, actually, he's writing that if I have opened a company in IFSA and in MOA, it is mentioned that I have subscribed share worth 30 lakh rupees, and he have filed form FC with bank and obtained UIN for the same. Do RBI compel me to repatriate 30 lakh rupees, or I will be considered as deferred consideration?
You can consider this as a deferred consideration. If you have the UIN, you can in the deferred agreement you can write as to when you want to send out the money. The RBI will not compel you to send any money.
Okay, and we have received online questions. What scope a newly passed CA does have in this field?
Newly passed CA has a lot of scope. Overseas, and this is one area of practice which is not very explored, I would say, because RBI as a practice feels a little daunting to start with, because there are a lot of guidelines that you need to consider. But the scope is unlimited, because I would say this is a green field. There are very few professionals in the field. So I think a newly passed chartered accountant can make a career in typically a regulatory practice. I would call this a regulatory practice, which is the RBI practice, because there's not only a FEMA practice, but then there is also a Department of Supervision which deals with NBFCs, for which again the regulator is RBI. I think there is massive scope for anybody recently qualifying.
So now someone is asking that can you briefly explain the significance of ODI in the context of Indian economical growth? I think you have answered that. Can you repeat it again?
Yeah, I mean, again, I think from an Indian economy perspective, ODI adds to Indian entrepreneurs trying to go outside, set up newer subsidiaries, work on, I would say, foreign ventures, get markets outside of India and expand. As I said at the start, build in India and build for the world, and that is happening. We are seeing that happening. I mean, mobile phones are the biggest example. You see, mobile phones are these days are getting made in India and sold outside. So I think overseas direct investment holds a massive scope, because with a small amount of investment as entrepreneurs, we can get a lot of money back home if we are able to generate those returns.
So regarding Dubai taxation, someone is asking if basically if a company is found in IFZA and they are selling the product to IFZA company itself, that is free zone company itself, then whether corporate tax will be liable or not.
So free zone to free zone, there is no tax liability. However, there are certain other conditions. You need to have substance. You need to furnish an audited chartered accountant's report, so on and so forth. So free zone to free zone, if you're doing goods per se, then the exemption stays. However, free zone to another free zone, even if you're doing services, the whole piece gets taxed. Not part of the query, not part of FEMA ODI, but yeah, I mean, still that's the answer.
Could you explain the role of LRS for facilitating ODI?
Yeah, so again, as I said, LRS is applicable to Indian individuals who can go ahead and make an application to their respective AD banks up to the extent of $250,000. Go ahead, establish the company outside of India. If the amount exceeds, you need to go to your AD bank. You need to seek a specific capital account approval and form the company.
So, what are the recent amendments in ODI rules and how they're impacting the ease of investment abroad?
Yeah, so these are all recent amendments. I mean, I can't call them recent because they came in June 2022. But they are but fairly new, because I mean, ODI guidelines have been in place. Although there was an amendment that came in September of 2020 as well. But these would be the latest that we have just discussed, and the biggest being the easing of the whole regulatory structure around round tripping, the guidance on deferred payment, as Anuj asked, and the whole mechanism where there is a lot more clarity now than it existed. So, for example, gifting of shares has been regularized. For example, investments into foreign subsidiaries by way of non-fund based limits have been given due importance to, because previously we were giving a lot of corporate guarantees on behalf of the foreign subsidiary or the foreign boss. That has now been regularized. So a lot of things the current guidelines have taught us.
But which sectors have seen the most significant outward investment from India in recent years?
Okay, I would not have a definite answer to that, but if I were to consider, I would probably see ITS as the biggest sector. I mean, yeah, I think ITS is the biggest sector that you've seen. Very interestingly, one important piece that happened, and I would like to briefly touch upon that, because I think it's important. IFSC, which is the International Financial Services Center in India, which is in Gujarat, the IFSC, the International Financial Services Sector, also has now, under the ODI definition, a foreign entity considered. So a foreign entity will also include an entity which is formed in the International Financial Services Center. So when I am actually making investment into a company in IFSC, that's not Indian entity, it's not a domestic investment, it's a foreign investment. That is another important aspect that we need to cover.
So can you please repeat the taxation point? If I sail from IFZA to Azman free zone, can corporate tax will be levied?
No, so corporate tax will not be levied if you are selling goods from a free zone to another free zone.
How does taxation work for Indian firms with investment abroad? Are there any double taxation avoidance agreement that investors should be aware of?
Sorry?
How does taxation work for Indian firms with investment abroad? Is there any DTA that should be aware that we should be take care of?
Yeah. So investment for, I mean, see the foreign was becomes a wholly owned sub, like a subsidiary. So the foreign was will be taxed on its income. There'll be no tax on the income of the foreign was. However, if the foreign was pays to, say, the Indian parent some sort of dividends or some sort of royalty or some sort of fee for technical services, that needs to be governed by relevant articles of the DTAA, because there is a transaction happening between two countries. Alternatively, you can also go to the section 115 capital A of the Act, where the guidelines of royalty and fee for technical services taxation and read with section 9 need to be encountered, and see as to how the whole income tax applicability happens.
Next one is, sir, what are the common challenges faced by the Indian businesses while making investment overseas?
I think biggest challenge lies with dealing with your AD bank and the whole documentation, which takes a lot of time. So somebody who's done that is something that you need to consider. And especially somebody who has a very good, and you as an entrepreneur, you need to have a very good banking relationship with an AD bank. Only then go ahead and choose that bank, because you can choose your AD bank. It's not as if you have to do it with a particular bank. You can choose your AD bank. You can choose, say for example, you're working with 3 banks. You can choose one particular bank, ICICI, HSBC, or whatever. You can also, if a particular bank, after giving you a UIN, is causing trouble and causing a pain, and you are not able to work with that particular AD bank, go ahead and take an NOC of the UIN from your particular AD bank and shift it to the other. So that is also possible. If a bank is troubling you enough and not cooperating, there are ways to get rid of that banking relationship and go to another bank. I just see a question on my tab which says, if I write off more than 10%, what would be the procedure? Yeah, so 10%, so a write-off beyond 10% is allowed, as I said, but it has to be in conjunction with approaching the AD bank with a relevant set of documents. 100% of the procedure, 100% of the investment can also now be written off, provided it's a capital account transaction, it's a regulated transaction. You approach your AD bank, you tell them as to why the write-off is happening, what is the reason. Do you have audited accounts of the entity? How did the business fail? Because you can't say tomorrow, you just can't stand up and say that $10 million of money is gone. Okay. Or even 1 million is gone. So you have to have a very strong justification as to why the write-off is happening. How did the business get conducted? Compliance for the entity needs to be 100% in place. You need to have a complete compliance, FLA, APR, share certificates, all of that needs to be completely in place before you go ahead for the write-off. So that's the main issue on the write-off. I see another question, and then maybe Ravi, you can go to your question. I see another question. If I am Indian resident, then whether DTAA beneficial provisions will apply? Of course. Whether you are a resident or whether you are non-resident, you just need to prove that you are a tax resident of a company, of a country. And for companies, you have a tax residency certificate, a TRC, which is produced. A TRC is given in India also, by the way. A TRC is given in UAE also, in the US also. All countries give you a tax residency certificate for companies. For individuals, the whole test is the residential status test, which is a section 6 test. And the Indian resident director beneficial provision will apply if you are an Indian resident. So yeah, DTAA is perfectly valid and applicable.
So another question is, can you suggest best practice for risk management in ODI?
Okay, so okay, I mean, of course, operational risks will be covered and taken care of by the management and the team working on the ground per se. But operational risks from a ODI management perspective are very important. So from an ODI management perspective, make sure that the forms are complete, because as I said, it takes 2 to 4 months sometimes for the whole ODI process to be complete, because in some cases the AD bank themselves is not able to issue the UIN if you are late. For example, Anuj asked the question that I've opened a company in IFSA and already obtained the UIN. Do I need to send money abroad? The answer is no. But what if in his case he would have opened the company and the shares would not have been subscribed and the UIN would also not have been taken, and you have not entered into even a deferred payment structure? In that case, you go ahead into a regularization mode. And when you go into a regularization mode from the RBI, it takes a lot of time, because the AD bank has to actually go ahead and submit to the RBI. The RBI comes back, and the whole process takes about 2 to 4 months. So the risk management piece exists not only from an ops perspective, it also exists from a managing the ODI perspective.
Another is, sir, can you please cover the poem place of factory management, where the officers of holding company in India is actually taking decision for the subsidiary company outside India?
Yeah. So so poem guidelines are applicable. Most of us know how poem guidelines are applicable in case the first test is 50 crores, whether your turnover is crossing 50 crores in the foreign company or not. Having said that, so if it's not crossing, of course, lesser victim management guidelines don't apply. But some countries now have the substance requirement. For example, the UAE now has a substance requirement. If you open a like Anuj asked, if there is an IFSA to an Ajman, so let's assume there is an IFSA company, and the IFSA company there is an office that exists. Okay. But nobody sits out of there. It's just a shell office. It's just a license, like a trade license of the company incorporation that you have done, and nobody is there at the office. No substance, just a shell company. The UAE themselves will tax you at 9% of the corporate tax rate, because there is no substance. Place of active management guidelines, of course, come later. So substance demonstration becomes very important, not only from a UAE perspective but from India perspective also, given that and you need to structure this. And how you need to structure is, you need to make sure that two directors or majority of the board is the foreign board. So don't have the entire board which is run out of India, the same board that runs the foreign boss also. You need to have a couple of employees there whose salary needs to be paid. They need to be on the rolls of the company. The marketing and the selling needs to happen from local UAE, or from the local country, so to speak. And you have to manage effectively the Indian director. If there are only two directors, one is foreign and then one is Indian, then the Indian director should make sure that at least thrice or 4 times in a year he travels outside India to the place where the foreign boss exists, to have a board meeting and to conduct the board meeting there. So all sorts of things you need to bear in mind, and the whole poem test from a substance requirement needs to be satisfied.
Otherwise, how is Indian government supporting companies that are expanding globally through ODI?
I think so. There is, if you know of, there is a full export promotion council, which is a services export promotion council, SEPC, that exists now. SEPC is one of the bodies that encourage Indian companies to go outside and sell. Uh, that's one part of it, which is Indian companies only going ahead and selling, even without doing the ODI. But as far as the government is concerned, I think what the government is doing is they are easing out regulations, because that's the thing that they can do. If you have a very very strict control on investments and hold them back in India, then the whole investment scene outside of India becomes very difficult and troublesome. I think they're easing out regulations. They're coming up with newer ideas in terms of round tripping being avoided, and even being allowed, to what extent it is allowed and how it is allowed. I think those are progressive steps that they're taking, so probably steps in the right direction.
Another one is, what is the impact of ODI on job creation and technology transfer back to India?
Yeah, so that's actually important, because I've seen a lot of clients come back into India uh, who have opened foreign wars, and they've realized that the market operates very differently outside of India. So, for example, let's take an example of, say, an urban company. Now, urban company, which was Urban Clap before, They went ahead and opened their offices in the UAE, but very soon they realized that the customer market and the customer perception is very different, and the way a customer perceives an urban company's services in the UAE is very different from the way a customer is perceiving services back in India. The ticket size is different, the whole service delivery model is different, and then you quickly need to tweak your tech, because technology still is handled by engineers and product teams who are sitting out of India. Technology has not moved. I mean, at least to a very large extent, technology delivery has not moved outside of India into the UAE. So it's important for firms to realize that this entire exchange of technology and talent, helps them a lot.
The question is, if IC sale occur by the phone company in TWI, I think is in territorial water, whether sale by the phone company is taxable in India.
Sorry, I didn't understand that. Sorry.
If IC sale, basically, I think IC sale basically is a sale done outside
Right.
the, yeah,
Right.
IC sale occur by the phone company in TWI, whether sales by phone company is taxable in India.
Okay. So let me break this down, the example, and maybe somebody can then tell me if I'm framing the question correctly. The Indian entity has a foreign VOS, and the foreign VOS is entering into high sea sales which are happening in the territorial waters of India. I think that is the question. And whether those high sea sales which are happening in the territorial waters of India will be taxable in the Indian company. Is that the question?
I hope so, sir. Well, I think the question is this. So I think this is the question because
Okay, so let me answer based on this assumption. Let me answer this, and I'll repeat it for the sake of the benefit of everybody. There is an Indian company. The Indian company has a foreign VOS, and the foreign VOS has actually made high sea sales in the territorial waters of India. This sale will be taxed in the books of the foreign company and not in the books of the Indian entity, because this is a sale which is actually being made in a contractual relationship which has been entered into between the foreign VOS and its client. Now, whether the transaction has happened in the territorial waters of India is immaterial, because a lot of times the foreign VOS is actually selling back to Indian customers also and billing to them also. The amount cannot be taxed in the Indian company, it will only be taxed in the foreign VOS.
what are the common mistakes businesses make when make outbound investment? How and they can be avoided?
So I've given out case studies. You saw, Ravi. I gave out case studies where whatever were the actual mistakes that people were doing, they were actually getting around to discussing the wrong discussion points, actually, because they were not adhering to the guidelines. Most importantly, just opening a company when I have gone on a trip. So I've seen this happen so many times. I've lost count. Somebody's gone out on a trip to, say, a Singapore or Dubai. Somebody has sold them the idea of a company. They go ahead, they open the company, and from there on they give, in their hands they have 10,000 dirhams or 5,000 dirhams or 50,000 dirhams in cash. They take it out and give it to the person who's helping them open the company, and then they come back thinking, what's the big deal? This has to be, of course, with more education and more awareness around foreign compliance and foreign investments outside of India. It is becoming a massive investment, massive consulting opportunity for people like us and tech members in the industry to educate entrepreneurs and founders as to how these kind of mistakes have to be avoided. And then the other mistake, very common mistake, is even after you have done the compliance for making the overseas direct investment, you completely forget about the compliance that needs to be done. There is an FLA that needs to be filed each year, APR that needs to be filed each year. People just forget about it and they continue business as usual. So they have done the hard part, which is taking the UI and approaching the AD and all of that, but they forget doing the compliance. So please avoid that. And I think those are some of them.
So, what are the key tax implications for the Indian companies under ODI, both domestically and in the host country?
So as I said at the start of the presentation, host countries, there has to be a mechanism where you understand the law. Like, for example, Anuj was asking on what happens to sale between two related companies or two companies in a free zone. in the UAE? What happens to local laws? How are dividends taxed? Most importantly, you need to understand how are dividends taxed, because ultimately you need to remit the money back into India, the profits back into India. How does that happen? How is the revenue getting taxed? On the local laws, the Indian laws, of course, the revenue per se or the operations per se of the foreign entity do not affect the Indian entity per se. But again, there has to be a very strict monitoring of why the foreign entity was opened and how transfer pricing rules govern the whole structuring mechanism of the India and the foreign entity.
Another one is that, are there any incentives, subsidies, or program that Indian businesses can tap into the foreign investment?
Sorry, was that again?
Are there any incentives, subsidies, or programs that Indian businesses can tap into for overseas investment?
I mean, see, so I'll give you an example. One of our clients, they opened a subsidiary in the UK. Okay, and the UK government, as part of the program, they were following a part of a program. The UK government gave them equity free grant, so it was basically free money for them to spend in the UK, because they were a technology company. They opened the UK and they started spending from that money that they received from the UK grant. So again, a lot of interesting incentives that are available to founders opening outside. We need to be mindful of the fact that uh, you do it right. It's about you doing it right.
Next one is, what role does due diligence play in the success of ODI? How can companies ensure that they are making informed decisions?
How can companies?
How can companies ensure that they are making informed decisions?
Yeah, I mean, as I said, informed decisions center around the fact that you need to be mindful of the host country's law, which is the company that we are opening the company in. You need to be mindful of laws that exist in India, both from not only from a FEMA perspective, but FEMA is one, income tax is one, transfer pricing is a third. So just need to be mindful of all laws together and make a complete plan. Because the other factor is, and this is something that I forgot to tell in my presentation. Money can leak very quickly if you don't act fast. And in geographies like, for example, say the UAE, I mean, we call it the running tap water in terms of funds, because it's very, very costly to operate a company sometimes in one of the costlier zones, say whatever Javza or a Davza, and so on. So please make sure that you're making an informed decision. The need to go outside and operate is 100% right. And yeah, I mean, those are the kind of informed decisions that you have to make.
Another one is that, for companies that have already make ODI, what factors have influenced your choice of country or sector?
See, sector, of course, they are. I mean, in the sector that they operate in, they are in that particular sector. The the country has to be determined on the basis of where their market lies and where they want to operate. I mean, one factor is, of course, you could locate yourself centrally. For example, if you want to sell in the Middle East, right now UAE seems to be the market. But I mean, probably 6 months, a year, 2 years down the line, maybe you'll also see that you will have maybe the Saudi Arabia come up big time as one of the markets for operating in the Middle East region. So again, a lot of things that you need to think of before you go ahead and actually incorporate. But again, markets and where the selling lies has to be thought out. The US, for example, when you set up in the US, you are even able to sell to Canada. You are able to cater to the North American market, even the South American market, Mexico, Chile, and so on and so forth. So yeah.
I don't think there are no other questions, I think.
Sure.
So I think we can conclude our webinar. Yes, I would like to thank you everyone for joining us today for the insightful webinar on ODI. I would also like to extend my heartfelt gratitude to our guest speaker, C. Siddharji, for sharing his valuable insights and expertise. Your experience and knowledge have undoubtedly enriched our understanding of the complexities involved in cross-border transactions. I will also like to thank Chairman of the committee for organizing this event and for the continuous effort to support members in this professional journey. A big thank you to all the participants for being here and engage in this important conversations. Your presence and cautions have contributed to the success of this webinar. Let's continue to foster collaboration and knowledge sharing within our committee. Thank you once again. Have a wonderful day ahead and a happy Diwali to you all. Thank you.
Thank you. Thank you so much, Ravi. Thank you. Happy Diwali to everybody. Thank you.
Thank you.